The thing about market structure is that because it's so simple, not many traders pay much attention to it. But the impact, the difference this made to my trading has been incredible. Super powerful. While technical indicators can definitely help in trading, having too many indicators on your chart can be confusing, especially when you are an active day trader and factor in multiple time frames into your analysis. So when analyzing a market, I like to start with a clean chart. That way, the first thing you observe is market structure, the simplest form of analyzing price movement in the market, so it really makes sense to start from here. Doing so has helped me improve key metrics like risk-reward ratios, win percentages, and in so doing, made me a much better trader. In today's video, I'll show you a few ways you can use market structure to improve your trading. Broadly speaking, there are inherently two types of market: a market that is trending and a market that is in consolidation. Let's first look at the first type. So we can have an uptrend. The uptrend is expected to continue in that direction until a lower low is printed by the asset price. This is a daily time frame chart of the E-mini S&P futures starting from March 2020. If you consider this market swing, you have a swing high and swing low here. The market made a new higher high and new higher low. At this point, the uptrend remains intact. So based on market structure, you expect prices to continue trading higher. We made another higher high and higher low. As long as the market continues to print higher highs and higher lows, the uptrend is intact, so the expectation is for the market to continue trading higher. A bear trend is essentially the same thing, pictured by a series of lower lows and lower highs, where the downtrend is expected to continue until a higher high is printed by an asset price. So here we have a daily chart of gold futures around August 2020. We can see that during this time period, gold in general was in a downtrend, making a series of lower lows and lower highs. So how can you use this information? If you identify a market that is trending, making a series of higher highs and higher lows, when price trades back to its recent lows, for uptrend to remain intact, by definition, the market must print a higher low. Knowing this, traders can buy into this dip at a pre-calculated support level, expecting the market to support and resume its uptrend. This gives us two things. Assuming the trend remains intact, this price zone near previous structure lows gives you a buy zone. When combined with good leading indicators, gives you higher probability trades. Identifying this buy area ahead of time allows you to zone in on your entries and buy into dips. Importantly, you can also hide your stop below structure lows, since the only way you will be stopped out is if the validity of the current uptrend is put into question. Not only is this a strategic method for stop placement, it can reduce your dollar risk on a trade when done correctly. So going back to the previous example on the E-mini S&P futures, if you believe that the existing uptrend will remain intact, you can enter a trade on the long side near recent lows with a tight stop below structure lows, giving you a great risk-reward ratio on the trade. Similarly, as we look at the previous example on gold futures, during that time period we had one of the most contested US elections, and gold was considered a safe haven and a good hedge against the political risk. Market structure, however, did not give you confirmation to remain excessively bullish on gold. In both examples, one can argue that the markets traded contrary to what the fundamentals suggest at the time, but a good understanding of market structure would have at minimum kept you from being on the wrong side of the trade. When you increase your win percentage and risk-reward ratios and improve your ability to get filled on a trade using good leading indicators, this will have a positive impact on your trading performance. All trends eventually come to an end, and by definition, a trend cannot end unless it first prints a lower low or higher low. This is what I call a change in behavior, which often precedes the second type of market condition. A sideways market will have price action that is forming almost equal highs and equal lows. Once a sideways market is identified, prices tend to trade in a range between two extremes and is in consolidation. Markets can move in a period of consolidation for a long time, but eventually this trend is broken when price breaks out from the top or bottom of the range, and the market can then begin a new uptrend or downtrend. Understanding market structure can have many benefits to a trader irregardless of one's trading style. In essence, you want to trade in the direction of a market that is trending, and you might want to avoid or range trade a market that is in consolidation. The key is distinguishing between these two types of markets, and after identifying that, know how to transition and trade within each of these markets. I have a technical pattern that I use that does just that, and it's made my life so much easier as a trader, and we'll be covering that in the next video. So let me know what you think about market structure. Can you see yourself applying this concept to your trading to help you get into better trading opportunities, improve your win rate and risk-reward ratios? If you find this concept helpful, hit the like button, and you might also want to check out this next video where I'll share more about this technical pattern that you can use together with what you've just learned here that will help you get even better results. This has definitely helped me get on so many profitable trades, so you definitely want to check it out.